Uncover true value. Analyze deeper.
We are tackling two really fascinating and quite different companies. Shopify, that's S-H-O-P, and Palantir Technologies, PLTR.
Yep. We've gathered everything the sources mentioned. Financials, technical charts, what analysts are saying, who's buying and selling among the big institutions, even details on their core businesses, and yeah, some of the controversies too.
Our mission here is to synthesize all of that, pull out the most critical pieces, and basically build a detailed story for you about what's going on with SHOP and PLTR right now, based purely on the information you provided.
Okay, but one crucial note before we jump in. All the specific numbers, we'll talk about market cap, stock prices, returns, those technical levels, analyst targets, everything is current as of May 31st, 2025, based only on the materials you gave us.
Okay, got it. Let's unpack this then, starting with Shopify.
All right, Shopify. Let's just quickly introduce the company itself. Founded way back in 2004 up in Ottawa, Canada. The names you see are Tobias Litke, Daniel Wynand, and Scott Lake as founders.
And Litke is still CEO, right?
He is, yeah. Tobias Litke is CEO, and Harley Finkelstein is president. Those are the key leaders mentioned.
So why Shopify? What makes them stand out? According to these sources, what are their core competitive advantages?
Well, the sources really focus on a few main things. First off, the platform itself. It's built to be really user-friendly, an all-in-one solution that makes it pretty easy for almost anyone to start selling online.
And it grows with you, I assume.
Exactly. Scalability is key. It works for the little guy just starting out, but it can also handle, huge enterprise-level operations. Then there's the ecosystem, that massive app store and all the partners they have.
Creates lock-in.
Sort of, yeah. Powerful network effects, more apps, more value, makes it harder for merchants to leave, high switching costs. And it all reinforces this very merchant-focused approach they seem to have.
Okay, so what does the platform actually offer? What are people paying for?
Right, so revenue comes from two main buckets. First is subscription solutions. That's your standard recurring revenue, the monthly or yearly fees merchants pay for using the platform. Different tiers, including Shopify Plus for the big guys. And second, which is actually growing faster, is merchant solutions. This is tied more to how much the merchants actually sell.
So things like payment processing.
Exactly. A cut of the GMV, gross merchandise volume through Shopify payments, transaction fees if they use other gateways, Shopify shipping, Shopify Capital for loans, Shopify Markets for selling internationally, POS hardware for physical stores. Quite a list.
So the customer base is pretty wide then, not just small businesses anymore.
Yeah.
No, definitely not. They started there with SMBs globally, but now it's also direct-to-consumer brands, big enterprises needing complex online or omni-channel setups, and even traditional retailers blending online and offline.
And what have they been focused on strategically lately? The sources mentioned a big push for profitability.
Yes, that's a major theme. After investing heavily in growth, they've shifted focus. Cost discipline, improving margins. A big part of that was selling off their logistics business, which was a huge move mentioned in the sources.
Makes sense.
What else? They're also pushing hard on international expansion. That's Shopify Markets and Pro, really trying to scale up the enterprise side with Shopify Plus. Integrating AI tools, Shopify Magic is mentioned, and strengthening that omni-channel link between online and physical stores with Shopify POS.
Okay, let's get into the numbers. Market cap around, $137 billion in May 2025. How's the stock actually performed?
Yeah, the price history tells quite a story, lots of ups and downs. So in the year leading up to May 2025, the return was about 20.86%. That actually beat the S&P TSX Composite Index, which is around 11.13%.
Okay, not bad for 1 year. How about longer term? 3 years.
3 years looks even better, actually. An 85.38% return versus just 14.72% for the index. So strong performance over that medium term.
But the 5-year picture is different.
It is, yeah. Over 5 years, it was 36.09%, which sounds okay, but it underperformed the index's 70.11%. That 5-year view really captures that major turning point.
You mean the huge run-up during the pandemic boom and then the correction?
Precisely. The stock peaked at $169.06 in November 2021. Then a really significant correction followed. The 52-week range, mentioned in the sources $48.56 to $129.38, shows just how volatile it's been and the ground it lost from that peak.
Okay, let's look at the technicals. The sources give a snapshot around April 22, 2025. What were the charts saying then?
Right. As of that date, the price was hovering around $85.71. And importantly, it was trading below both its 50-day moving average, which was about $92.07, and its 200-day, around $101.06.
Which is usually seen as bearish.
Typically, yes. Trading below those key averages often indicates a bearish trend, suggesting near-term momentum is weaker than the longer-term trend.
What about momentum indicators like RSI or NPD?
The RSI, Relative Strength Index, was pretty neutral, right in the middle at 47.3, not clearly overbought or oversold. The MACD, that's Moving Average Convergence Divergence, was negative at negative 2.9, which kind of confirmed that bearish momentum. Although one source did note that by late May, while MACD was still negative, it was starting to rise a bit. So maybe a sign selling pressure was easing slightly, but a mixed signal there.
And key price levels to watch. Support and resistance.
Support, where buying might emerge, was seen around the $80 mark. Resistance, a potential ceiling, was near $100, which lines up pretty well with that 50-day moving average. There was also talk of a near-term breakout zone around $108.77, and one source pointed to a one-month low support level at $88.14 back in April, which the stock was actually just below at that $85.71 price point.
How about earnings surprises? Have they been beating expectations?
Looking at the period from Q1 2023 to Q4 2024, the sources say Shopify actually beat analyst estimates in 5 out of those 7 quarters. They did miss twice, in Q4 2024 and Q2 2023, but mostly they met or exceeded expectations.
Okay, and back to margins for a sec. You mentioned the gross margin percentage went down. Can you clarify again why that happened?
Yeah, this is important because it can look negative at first glance. The overall gross margin percentage decreased. But the reason, according to the sources, is that the lower margin merchant solutions segment is growing faster than the higher margin subscription segment.
Oh, all right.
So the mix is shifting. The faster growth in the lower margin part pulls the average down. But crucially, the company can still become more profitable overall because the total revenue is growing and they're getting better operating leverage. It's about the mix, not necessarily declining health of the core segments.
Got it. That makes sense. What about risks? What are the main worries highlighted in the sources?
Well, there are the standard risks, of course. Fluctuations in quarterly results, big one for growth stocks. Sensitivity to analyst reports and news, market conditions changing, insider selling, key people leaving.
And volatility.
Yes, definitely highlighted. The beta mentioned is 2.18. Beta over 1 means more volatile than the market, and 2.18 suggests it can swing quite a bit more, up or down. Other things mentioned, potential class action lawsuits, especially when the stock price is volatile, and risks tied to their debt. They have credit facilities and notes that restrict certain actions and require cash for things like buybacks or conversion.
But dividends, any chance of those?
Sources are clear. Nope. Shopify has never paid cash dividends. They plan to keep reinvesting earnings back into the business. Don't expect dividends anytime soon. Pretty typical for a growth company, but also subject to board decisions and those debt agreements.
Okay, that covers the financials and risks pretty well. Let's talk sentiment. How do the big institutions feel about Shopify?
Institutions hold a huge chunk, 69.27%, according to the sources. And there's been a lot of activity in the past year. About $12.15 billion flowed in versus $8.78 billion out. So net buying from institutions overall.
Any standout moves recently? Big buys or sells?
The biggest recent buy mentioned was BlackRock. They picked up almost 57 million shares, worth about $6 billion back in December 2024. Really increased their stakes significantly. On the sell side, Bailey Gifford trimmed their position a bit in February 25. Private Wealth Partners, LLC, cut their stake by over 60% by April 25. And interestingly, Soros Fund Management completely sold out back in Q2 2024.
So BlackRock buying big, but Soros getting out entirely. A mixed bag.
Definitely. Some major players adding, others reducing or exiting. No clear consensus there.
Which ETFs have big chunks of Shopify?
Mostly innovation-focused ones. ARK FinTech Innovation ETF had 9.34%. First Trust Dow Jones International Internet ETF, 8.99%. ARK 21 Shares Blockchain and Digital Economy Innovation ETF, 8.77%. So it's seen as a key player in that, digital economy space.
What's the analyst consensus as of late May 2025?
Generally a moderate buy. The score mentioned was 2.63, where 1 is strong buy and 5 is sell. One source noted a predicted upside of about 40.44% from the price level they were looking at. And news sentiment around the company was reportedly positive too.
And price targets. Are analysts aligned there?
Well, analysts are rarely perfectly aligned. Targets vary quite a bit. Some sources mentioned average targets pointing to maybe $82 on the low end, others like $93.89 from Barchart or even $130 from Goldman Sachs. But it's also worth noting that back in April 2025, a whole bunch of firms, Goldman, RBC, Morgan Stanley, Cantor, Luke, Mizuho, D.A. Davidson actually lowered their targets.
Even if they kept a buy rating.
Yeah, some did suggest maybe expectations were being reset a little, even among the bulls.
How's management perceived? Litkey and Finkelstein.
Perception seems pretty strong based on the execution metrics highlighted. The sources point to things like 7 straight quarters of over 25% revenue growth, 6 quarters over 20% GMV growth, 9 quarters of positive free cash flow, 6 with double-digit margins.
Pretty impressive numbers.
They are. It suggests management is seen as very capable, able to scale the business across products, regions, and customer types while hitting those profitability goals.
Okay, let's synthesize this. Company profile, numbers, technicals, sentiment. What's the potential outlook for SHOPIFY over the next, say, 6 to 12 months? What's a bullish view?
All right, the bullish case, the one that might see the stock head towards that $95, $105 range, relies on a few things mentioned. Continued growth in e-commerce worldwide is a big tailwind. Getting more merchants signed up, especially overseas where GMV grew 33% recently, expanding margins further as they scale, and accelerating growth in that high-end Shopify Plus segment. Plus, that strong management track record helps the bull case.
And the flip side, the bearish scenario. What could push it down towards those $70 support levels, or the lowest analyst target around $79?
The bears focus heavily on the risks. That technical downtrend seen in April is a big one for chartists. Valuation concerns just don't go away. That forward PE of 256x mentioned online is eye-watering, even with improving margins. Potential for margin pressure, despite the mixed explanation, sentiment doesn't always follow the numbers perfectly. Competition is fierce in e-commerce platforms.
Signs of volatility.
And the high volatility, beta 2.18. Plus, any economic slowdown hitting their main SMB customers could really hurt. Upcoming events like the Q2 earnings are big potential swing factors, too.
Okay, that's a really thorough look at Shopify, a company with obvious strengths in execution, but also wrestling with valuation questions and some technical weakness recently.
Exactly. It's definitely not a straightforward picture.
Right. Let's switch gears now to Palantir Technologies, PLTR.
Yeah.
Very different beast.
Very different indeed. Founded even earlier, 2003. And a pretty famous founding team. Peter Thiel, Alexander Karp, Joe Lonsdale, Nathan Gettings, Stephen Cohen. Headquarters are in Denver now. Karp is CEO, Thiel is chairman.
And we had that fun fact from the sources about the acronym PLT.
Oh, yeah. Outside the stock ticker, PLT can mean platelet, pilot, platoon, all sorts of things. Just a little trivia point the sources included.
Okay, back to the company. What's Palantir's core purpose? Their why? What's their edge?
At its core, Palantir builds software for integrating and analyzing massive, complex data sets to help organizations make decisions and take action. Their edge comes from their proprietary platforms, Gotham, Foundry, Apollo, and their deep, often sensitive relationships, especially with government and intelligence agencies. Plus, their expertise in applying AI to these complex decision-making processes.
Can you break down those platforms?
Okay. Right. Gotham is their original platform built primarily for the defense and intelligence world. Think global defense agencies, intel communities. Sources even mention its use by the Ukrainian military. It helps find patterns, plan operations, coordinate responses in the real world. Then there's Foundry. This is aimed more at the commercial sector. It's designed to be like a central operating system for big companies and industries. Helps them integrate all their different data, analyze it, and fundamentally change how they operate. Clients mentioned include Morgan Stanley, Merck, Airbus, Ferrari. It's also used in healthcare, like with the NHS in England, though that came with some privacy concerns mentioned later.
How does it compare to other data platforms, according to the sources?
Well, online sentiment mentioned compares it sometimes to Databricks or Snowflake. Some users apparently find it complex, maybe some friction with IT departments, but others really praise its ability to empower the business side directly, and features like the Lineage app for tracking data seem unique and valued. And finally, Apollo. This is kind of the behind-the-scenes engine. It manages software delivery and updates across different environments, cloud, on-premise, wherever Gotham and Foundry need to run reliably.
And the big new thing is AIP.
Yes, the artificial intelligence platform. This layers generative AI, like large language models, onto their existing ML capabilities within Gotham and Foundry. The idea is to let organizations use these powerful AI models safely on their own private data to help with basically every decision. It's a huge part of their current pitch and why some rank them as a top AI vendor.
Partnerships also seem really important for them.
Definitely. It's a core part of their strategy. Joint ventures, channel sales. They partner with the big cloud providers, IBM, AWS, Azure, to leverage their sales reach. Also with global system integrators and specific industry players like Fujitsu, Satimpio, HD Hyundai, and that long-running Airbus Skywise partnership.
But the sources also flag risks with these partnerships.
They do, explicitly. Partners might not sell or implement as well as Palantir themselves. Palantir might lose visibility or control. Conflicts of interest could arise. Maybe they can't work with a partner's competitor. Customer satisfaction might dip. Partners could even launch competing products. And if a key partnership fails or ends, it could really hurt business, contracts, growth, lead to costs and bad press.
Okay, now we need to touch on something the sources highlight as a significant factor and risk for Palantir. Its history with government work and the controversies surrounding it. And just to be clear, we're reporting neutrally on what's in the sources here.
Absolutely. The sources point to several specific controversies listed as potential risks. A major one is the ongoing work with ICE, Immigration and Customs Enforcement since 2014. Critics cited argue Palantir software is mission-critical for ICE, potentially aiding deportations. Amnesty International is mentioned for criticizing their human rights due diligence on this. And recent reports from April 2025 about potentially helping ICE deport more people show this is still a live issue, according to the sources. There's also the connection to Cambridge Analytica mentioned. Sources cite testimony that staff from both firms worked together using that harvested data. This raised data privacy and ethics flags, which sources link to later concerns about work with HHS Protect Now and the NHS in England.
Project Maven too.
Yes, Project Maven, involving AI for military use, also drew scrutiny. Ethical questions about AI and warfare leading to opposition, similar to what Google faced. And the sources stress that these controversies can lead to legal issues, inquiries, which the company acknowledges might increase. They're costly, time-consuming, divert attention, and can create negative publicity that hurts perception, whether the claims are valid or not. The 2024 10K report is cited as explicitly listing these risks, including harm from news or social media, and shifting political or social views on security and privacy can also impact them.
Okay. Shifting from controversies to the financials, how are Palantir's numbers looking?
Revenue growth has been pretty strong. $2.87 billion reported for 2024, with two-thirds of that from the U.S. That was up from $2.225 billion in 2023, where about 62% was U.S.-based.
And the big milestone was hitting profitability, wasn't it?
Absolutely crucial turning point. The sources make a big deal of this. They went from net losses like $374 million loss in 2022 to actual net income, $210 million in 2023, and then a jump to $462 million in 2024. Their total assets have also grown quite a bit, and they have more cash on hand.
But what about valuation? The sources mentioned some really high metrics.
They did, yeah. As of that April 22nd snapshot, the PE ratio was cited at a very high 476.9x. Price to sales also very high at 76.9x. These traditional metrics suggest the stock is priced for enormous future growth.
Which relies heavily on that AI story, presumably.
Presumably, yes. The potential in commercial AI seems to be supporting that valuation, though the sources also float the idea that the multi-class governance structure might be holding the valuation back a bit compared to what it could be otherwise.
And just like Shopify, no dividends expected.
Correct. Same story. Never paid them, intend to retain earnings for growth. Don't expect them soon. They hold U.S. Treasuries for operational cash needs.
How about the stock price journey for PLTR?
It's been volatile, too. The sources show about a plus 14% return over 1 year, October 23, October 24. But the 3-year return is negative 38%, reflecting that post-2021 correction. Zoom out 5 years, though, and it's still up significantly, plus 105% despite the bumps.
Any specific events that really moved the needle, according to the sources?
Yeah, a few stand out. That Q1 2024 earnings report in May 24 was big, strong growth. Positive free cash flow stock jumped 15% in a day, announcing AI commerce tools in June 24, and updating subscription pricing in August 24 also caused noticeable moves, sometimes up, sometimes triggering sell-offs.
Let's look at the technicals again, around that April 22, 2025 date.
Okay, price was around 93.99 cents then. One source mentioned a golden cross, the 50-day SMA moving above the 200-day SMA. Back then, the 50-day was around $86.09, the 200-day near $75.05. That's generally seen as a bullish signal, suggesting strengthening momentum. RSI was neutral-ish at 56.9.
But the man-seated signal was conflicting in the sources.
Yeah, a bit unclear. One source showed a positive MACD, 2.1, indicating positive momentum. Another mentioned bearish crossover around the same time, suggesting momentum might be waning. So some ambiguity there in late April-May. Key support levels mentioned were $97, $83, and $66. Resistance was seen way up near $125, but with a warning about a potential double-top pattern forming there, which could be bearish.
What are the major risks facing Palantir going forward, according to the sources, besides the controversies?
A big one is still that dependence on government contracts. They can be huge, but also unpredictable, lumpy, subject to political winds. That very high valuation is a constant risk. Any misstep on growth could hit the stock hard. Other risks mentioned? Potentially not being able to use all their tax loss carry-forwards, risks with international sales, regulations, export controls, ongoing litigation potential. And technical one from the 10K meeting, Sarbanes-Oxley rules for internal controls failing that could risk their NASDAQ listing. Plus the usual suspects: volatility, market conditions, insider selling, key people leaving, class action risk, and that multi-class share structure limiting outside influence.
Okay, sentiment check. How are institutions positioned?
Huge institutional interest. Sources mentioned over 2,800 institutional owners holding about 1.3 billion shares. Their ownership increased recently, too.
But are they all buying? Or is it mixed like Shopify?
Very mixed. Even more divided, maybe. In Q4 2024, you had big buys from Morgan Stanley, BlackRock, Goldman, Norges Bank. But in the same quarter, Vanguard and Renaissance Technologies were major sellers. Go back a bit earlier, Q2, Q3 24, ARK and Vanguard were buying, but Soros completely exited, just like SHOP, and BlackRock had been selling before their big Q4 buy.
Wow, yeah, zero consensus there.
None at all among the big players. Complete divergence of views.
How about the analysts? Are they any more unified?
Nope, pretty split there too. Often averages out to a hold overall. One source had 4 buys, 11 holds, 3 sells out of 18 analysts, average target barely above the April price. But another source, maybe more recent, called it a moderate buy with 8 strong buys, 6 buys, 4 holds. So again, division, maybe leaning slightly more positive recently among some.
And the price targets reflect that division.
Massively. The range is incredibly wide. You see targets as low as $40 in a bear case or $79 from the lowest analyst. Then you see targets like $87.50, $93, $89, $95, going all the way up to $110, $115, $130, $140, and even $150 from Bank of America.
That's a huge spread.
It really highlights the fundamental disagreement on how to value this company and its future, especially with some of those higher targets potentially coming out, even as the stock traded well above that April level.
What's the logic behind the holds or sells?
Starts with valuation, usually. Those high PE-PS ratios. Concerns about government revenue predictability, lumpiness, corporate governance, that multi-class structure and founder control bothersome. High stock-based compensation, or SBC, is often cited as a negative, diluting shareholders or impacting profits depending how you account for it.
Yeah.
And those ethical concerns and risks we talked about.
And the bulls.
Yeah.
Why the $150 targets?
They focus on the tech moat, how hard it is to copy what Palantir does, the massive potential of AIP, the AI platform, and seeing its adoption accelerate in government and commercial. Strong growth in the U.S. commercial side is seen as proof the strategy is working. And just the sheer size of the potential market for their tech. Online bulls talk about AIP adoption, space partnerships like SpaceX, and this idea that Palantir could become the next Oracle or Salesforce.
So wrapping up the outlook for Palantir.
The bearish scenario really hammers valuation as the #1 issue. Then the government revenue uncertainty. Insider selling is also a big red flag for bears. One source mentioned tons of sales, 0 buys over 6 months, and competition from the cloud giants, Azure, AWS, Google getting better at AI analytics. That view suggests the stock could really struggle.
And perception of management. Alex Karp.
Karp is definitely seen as unconventional, philosophical. He gets credit for taking the company public and pushing into commercial markets. But that multi-class share structure remains a governance concern for some. Overall, launching AIP and hitting GAAP profitability has definitely boosted sentiment over the last year or so. User views, like on Reddit, are mixed. Some find Foundry complex for IT. Others love its unique capabilities like that Lineage app.
Okay, so we've really gone deep into the sources you provided for both Shopify and Palantir.
Yeah, 2 very different companies. Shopify enabling e-commerce globally, Palantir building these powerful data AI platforms initially for government, now expanding out, each with its own unique history, financials, risks, and very debated sentiment.
For Shopify, we saw that balancing act. Growth versus profitability, navigating competition. Technicals looked a bit weak recently, despite strong execution metrics historically.
And for Palantir, a company shaped by its sensitive government origins and controversies, now betting big on commercial AI, improving profits, but trading at sky-high valuations that really divide people. mixed technicals too.
So synthesizing all this gives you, the listener, a really layered picture. Definitely not a simple buy or sell for either, is it? It's a complex mix of tech, growth, profits, market mood, and for Palantir, those unique ethical questions and governance setup.
Which really leads to a key question for you to think about. When you look at tech companies like these, especially ones with unusual models, a huge e-commerce ecosystem, or a government-linked AI firm, how much weight do you give to traditional financials and analyst targets?
Compared to what?
Compared to things like, the potential for massive future growth driven by new tech, like AI, or the management's track record and style, or even those less conventional things like controversies or how the company is governed, where do you place your emphasis?
That's a really good question. A lot to chew on there for anyone investing in this space.
Indeed. You really need to look at the whole picture, beyond just one type of metric.